I've been asked in the comments to take a closer look at Crocs company and value it based on the free cash flow. It's an American footwear company from Colorado. I think everybody knows what the company does and knows those shoes. We can see the stock has been down significantly over the past year, down over 50% from its all-time high, I think even more, 52% from its all-time high, but we can see it had a significant jump in the past days because they recently announced their earnings. You can see they beat on earnings and revenue estimates. The earnings were $2.97 per share and analyst estimates were only $2.58. It's up 20% from the earnings of last year and revenues up 57% year over year, which shows very strong growth. If we take a look at the financials, we can see it's currently trading at a PE of 8.6 and a forward PE of 8. The market cap is $5.2 billion. If we take a look at the revenue per share, we can see that it kept increasing, which is somewhat surprising to me, as I expected the company to be a little bit more cyclical. The earnings per share, they kept growing since 2017, and they had a really big jump in the past 3 years. The same with free cash flow per share, and they don't pay a dividend yet. If we take a look at the annual growth rates, we can see that for revenue, it's been 10% over the past 10 years, and for cash flow, 105% over the past 5 years. The earnings are up 240% over the past 10 years, but this is a little bit exuberant because we can see earnings have been very low in the past and even negative. Let's get into valuation. As you can see, revenue kept increasing in the past years. Analysts expect the revenue to keep increasing, growing at 51% as we have seen in this year, and then 11% and 10%, which seems reasonable to me. The number of shares outstanding, in general it has been declining, but for some reason they increased it in the past year. They issued some debt in 2021 and 2022, and analysts expect free cash flow to stay in between $400 to $600, which the number is in $1 million. In a normal case, I would expect the growth rates to come down, as I think we all know that those shoes are very long lasting, and I don't think that people need to buy 10 Crocs. They buy one pair and then that's fine for a few years maybe. At least that's my opinion. And therefore I'm bringing down the growth rate. We have seen it's been 10% annually over the past 10 years. I'm bringing it down to be a little bit conservative, especially when we're looking into the future and things get less certain. Fair free cash flow yield of 7% is reasonable. It's a little bit more conservative than the market is most of the times. And we can see this would give a very nice internal rate of return of nearly 14%. In the best case, I don't see Crocs growing in the double digits for a decade. So therefore, I'm starting at 9% year over year and then also slowly declining it. We get 16%, or we would get an internal rate of return of 16%. In the best case scenario. In the worst case scenario, I want it to be very conservative because I always want to look at the risk and reward of a stock. So in this case, I'm assuming that everybody who wants Crocs has already bought them, and therefore the sales stop growing and the company slowly declines. We can see 0% growth in 2025 and then slowly declining it, therefore also a higher free cash flow yield, which would still give us an internal rate of return of 7.2%, which is in line with the market. If we look at the combined result, we can see at the current price, it's possibly 30.4%. And if the stock price drops, the internal rate of return gets even better. So what's my opinion on the stock? I think that probably not many people look at it and value it, and probably because the business model isn't too fancy, it's not a very attractive and famous stock. And this could be a chance because yes, the valuation is very low for the stock. You get a lot of free cash flow for the price you pay. But I'm not so sure about the business model, and you have to decide this on your own. You have to make your own research and make your own decisions. And you have to decide if you think that the business model is sustainable and that people will keep buying those shoes. If you think that people won't buy those shoes in 10 years and that the sales will start to decline when at some point everybody who wants to own those already has bought some pairs, then you probably shouldn't buy the stock. If you're certain that people will keep buying those shoes and that it's a great business model, then yes, at the current valuation, it's a very interesting stock. If you want to see an analysis of a growth company that I recently made, please take a look at the pinned comment below. It's an analysis for Airbnb stock. Have a nice day and see you in the next one.